Hi, my name's Claire Gallagher. I'm one of the tutors here at Tolley Exam Training, and I'm just going to run through a session to help with some of the benefits that we see under employment income. Now, in this session, I'm going to cover loan benefits. I'm also going to cover use of assets and then the transfer of assets, and then I'm going to finish off by looking at living accommodation. Now, these four benefits have set rules. However, there's various twists which actually students fall for in the exam. So what I want to do in this session is highlight those twists and make sure we're looking out for them. Now, the first one I'm going to start with is the loan benefits. And the first thing I just want to mention is that loan benefits are not actually applicable if our loan is, of course, less than or equal to £5,000. So as long as during the tax year we don't owe more than £5,000, we don't actually have a taxable benefit, and instead that would be exempt. Now, if we did have a loan of above £5,000, there's various different ways in which we would need to calculate our actual benefits. There's two ways, and what we'd need to do to maximise our marks is do two methods, compare the two, and then we would take the lower of the two to carry forward into our pro forma. So, of course, those methods that I'm talking about are the strict method and the averaging method. Now let's start with the strict method. So the strict method is where we look at how much is outstanding month by month. So if we take an example, let's put some numbers in. If on the 6th of April 2012 there is a loan of £10,000, and then on the 1st of Feb 2013 £2,000 is repaid. Let's see how we deal with that for both of these methods. So let's start with the strict method first. So what we're basically saying here is how long did I actually have £10,000 outstanding? And once I had repaid £2,000, I obviously had £8,000 outstanding. So if we count April, May, June, July, August, September, October, November, December, January, it means we had £10,000 outstanding for 10 of the months, and then we had the remaining £8,000 outstanding for 2 of the months. Now, what's really important here is we did have something taxable for every month in that tax year. So we did owe some money, so it is right that when I add up the tops of those fractions, I do get back to my full 12 months. Now, of course, that's not our benefit there, because in actual fact, our benefit is then times by the official rate of interest, which is 4%. Okay, and we can get that on our tax tables, but that's generally always 4%. So we do our 10,000 times our 10/12 times the 4%, 8,000 times 2/12 times 4%, and we would get our figure of 386. Now, if we do it using the averaging method, what we're going to do on this side is just look at how much was outstanding at the beginning of the tax year, how much was outstanding at the end of the tax year, and then take the average of those two numbers. So that's what was outstanding at the beginning, that's what was outstanding at the end, and then again, once we've got those numbers in there, we're going to times by the official rate of interest, which is the 4%. Now, if we do our 10,000 plus our 8,000 divided by 2, we get 9,000. Then we times by our official rate of interest, we get £360. So we'd get marks for showing the strict method, we'd get marks for showing the averaging method, and then the final thing we would need to do is show that we've compared the two, and we are going to use the lowest of the two. Okay, now, like I mentioned, the revenue would probably prefer the higher of the two, but for exam purposes, if we're doing this on behalf of an individual, we would always opt to use the lower number of the two. Now, let's talk about some twists in terms of loan benefits. So like I mentioned there when I talked about the fact that the tops of our fractions would add back up to 12, and that would be correct because, of course, we were looking at this for a 12-month period. Obviously, if you take a loan out partway through the year, or if you clear the loan partway through the year, then you're not going to actually have a loan benefit for the whole of the tax year. or you shouldn't do when you actually come to do your time apportioning. Now, the other thing I want to consider is the fact that we don't necessarily always have interest-free loans. So sometimes they may tell you that the individual will pay 1%, 2%, but basically if they're not paying the 4%, they're still having a benefit, but if they're paying something towards it, we just need to take that into consideration. Now, if we have a look at the following example, so this will cover all of these little twists that I was talking about. So if Bob was lent $75,000 on the 6th of June 2012, so partway through a tax year, he then repays $25,000 on the 6th of December 2012. His charged interest of 2%, so again, it's not an interest-free loan, so we're going to have to take that into consideration. And we need to calculate his taxable benefit for the 2012-13 tax year. So let's start with, firstly, the averaging method. Now, if I start with the averaging method, I don't actually have any loan outstanding at the beginning of the tax year. But I don't put 0 in. What I have to do is put the amount of loan outstanding at the first point of the tax year, but then we're going to time apportion our fraction in order to take into consideration that there was a period where the individual didn't actually have that loan. So I'm still going to put my $75,000 in for the start of my fraction. So he did owe $75,000 when the loan started. He's then repaid $25,000, so at the end of the year he owes $50 still. I'm going to take the average of that, and I'm going to times by my 4%. Now, you may think that he's paid 2% interest, so maybe we should just times by 2%. So actually, he has received the 2% benefit. He should have paid 4, he's paid 2. Why can't we just times by 2? Well, that wouldn't be the correct answer because he hasn't been paying his loan instalments every single month. Because he's made a lump sum instalment in December, it wouldn't actually calculate that interest was paid the same every month, which is what would happen if we did apply that 2% there. So this is a really important point, that if somebody is paying interest and they're not paying the same every single month, we can't actually change our percentage that we have here. Not for the averaging method anyway. We could do it for the strict method because that is taking the different time periods into consideration. So what I'm going to do here is leave that at 4%, and then what we will do instead is actually go off and calculate the actual amount of interest that was paid in a second. Now, I'm not quite finished with this formula because, as we mentioned, he did actually take the loan on the 6th of June. So as things stand at the moment, that formula is representing a full tax year. What I therefore need to do is times it by 10/12, and then that takes into consideration that he should only be chargeable for 10 of those 12 months. Now, if we run that through the calculator, we should get £2,083. Now, I'm just going to come back to the interest paid. So in terms of that as an actual amount of benefit, so we're saying by the averaging method we get a £2,083 benefit. However, there is an employee contribution because the employee contribution is in fact the interest that has been paid. It's the same thing. So what we need to do is work out exactly how much was paid. Now, if he was owing £75,000 originally, so he took the loan out in June and he didn't pay anything off until December, so he's got a 6-month period where he owed £75,000. So if he's paid 2% for those 6 months, he would have paid £750. Okay, quick bit of math. And then if we look at the final period, so he then cleared $25,000, he had $50,000 outstanding, and again he's paid 2% interest for the remaining 4 months. Okay, so if we just work out exactly what he would have paid there, he would have paid £333. So that gives me a total of £1,083, that's the interest that he's paid. Now, if we just do a very quick calculation back with the averaging method, if you had actually, instead of putting 4% in there and timesing by the 10/12, instead putting 2% in, you obviously wouldn't have got the same answer. So what we should get when we actually use this figure here and we then deduct it from our averaging method is we get a nice round benefit amount of £1,000. And we wouldn't have got that if we'd put 2% in instead of that 4%. Now that's one method. So we don't stop there. Remember, we need to do full calculations. So now let's have a look at the strict method. So if I have a look at the strict method, this one's going to be a bit easier because we've actually done all the hard work already. So we know that he owed $75,000 for 6 months, and we're going to tax that on the benefit amount, and we find that benefit amount by timesing by the official rate of interest. Now it's at this point that I could actually put 2% in there instead of 4% because I am doing it accurately based on the number of months he owed that $75,000. Now I'll leave it at this for the second, and then we'll come back. So if I do $75,000 at 4% for 6 months, I get £1,500. Now again, he repays $25,000, so there's $50,000 outstanding, only for 4 months, and again, we'll just use that 4% for the time being. So this time round, I actually, using the strict method, get a taxable benefit of $2,167, but again, I need to deduct the employee contributions, the 1083. And that gives me a figure of £1,084. Now, what I could have done there is instead of actually using the 4% here, I could have used 2% instead and then not done that contribution there. I would have got exactly the same answer. Okay, but what I want to show you on this is that you can't use it on the averaging method because you're just averaging amounts out. You're not looking at it accurately, you're not bearing in mind exactly when the interest is paid and therefore what that figure relates to. Now I thought that question, that example will hopefully prove those 2 points. So one was just looking at time apportioning in terms of not having the loan for the full tax year, and the other where we don't have an interest-free loan but we do have some interest paid. And sometimes they won't tell you what percentage the interest is, they'll just give you a figure. And if that's the case, you just treat it as a normal employee contribution. Now, one thing I just want to point out before we move on from our loan benefits is if you just have a look here, when I've done my strict method, I've got 6/12 and I've got 4/12. Now, some people would put 6/10 and 4/10, but that's incorrect because remember what I said in the previous example, if your top and the tops of your fractions add up to the bottom of your fraction, that means you've got the actual benefit for the full tax year. So the fact that we've got 6 plus 4, which is 10, that's right because we've only got to have the benefit for 10 of the 12 months. Now, what you can do if you often get this confused and you end up actually putting the 10 underneath, for example, is just make a point of saying, well, actually, I owe nothing for 2 months. And if you put this extra bit in here, it will stop you doing that because then, of course, your tops do add up to your bottom. Okay, so that's our loan benefits. So let's now talk about use of assets. Now, use of assets, let's just start a new section. Use of assets follow generally 2 rules. We're going to be looking at 20% of the market value, and we're going to be comparing that to the rent paid by the employer for the asset. Now, obviously, if the employer owns the asset, there's not going to be any rent paid, and we can just go on the 20% of the market value. And most of the time that's the case, but if they did give you both of these, we would always use the higher of the two. Now, the most important thing about this rule, and not many people appreciate this, is when they say it's 20% of the market value, this market value is when it was first made available to an employee. So it's not the employee that you are necessarily doing the benefit for, it will be an employee. So if it's ever been used by anybody else in the past, that's what you're actually going to have your benefit calculated on. The market value when that original person used the asset. So that's something we need to be very careful of. Now, likewise, like with all of our benefit rules, we then consider if we've used it for the full year, we time a portion. If we haven't, and then if we have contributed towards the asset, we would also deduct that contribution. Now, to show this point, let's again just have a look with some numbers at an example. So what I have here, if we just read through, is Bob is given use of a plasma TV on the 6th of April 2012, so right at the beginning of the 12-13 tax year, and it was worth £1,000. Now, they're also telling you that the company bought it in 2010 for £3,000, and it was lent straight away to another employee called Simon. You're then asked to calculate Bob's taxable benefit for that tax year. So, what is this actually telling us? Can we put across through that bit of history telling us what had happened back in 2010? No. That's really important because if you think back to that rule I just mentioned, we're going by market value when it was first made available to an employee. Now, in this situation, it was first made available to Simon back in 2010, and it was worth £3,000 at that time. They bought it and they let him use it. Now, the company had bought it, so there's no rent paid. So what we would be doing here is 20% of that £3,000. It's actually the £1,000, the market value when Bob gets to use it. That's the bit that we're actually ignoring. So our benefit here would be £600. And then again, we look for time apportioning. Well, there's no issue here because he's had it for the full use of the tax year. Has he contributed towards it? No, he hasn't as far as we're concerned. So his taxable benefit would be £600. Okay, so hopefully everyone can see that bit of history kicking in. You've always got to say to yourself, is it a red herring or are they telling me that for a reason? So that's our use of asset rule. Now that leads us nicely on to the transfer of assets, because if you, for example, have been using that asset and then your employer says to you, well, you can have it, you can keep hold of it, we're then going to be comparing two different values. Now the two values we're going to be comparing is the market value at the transfer, and that's the transfer now, and we're going to be comparing that to, so we're going to go against the market value when it was originally lent or used by, and again, here are those key words, an employee. So we're not looking at the market value when we had it, for example. If somebody else has had it before us, we're going to be basing it on the original value when it was first used. Now, even by looking at these two values, there doesn't seem to be much of a competition, because the market value now at transfer, well, that's going to be a lot less, assuming things will fall in value as they tend to do, than the market value when it may have been brand new and then first used by an employee. So what we're doing to actually even this out is, of course, they do let you deduct over on this side here any amounts that have been chargeable where the asset has been used. Okay, so if you think back to our previous example, let's say that I've now been given the asset and it's been transferred, so that plasma TV, let's say it's been transferred to me now and it's worth £500. But if you think back to that previous example, it was originally lent to Simon when it was worth £3,000. Now that seems a huge amount in comparison. So £3,000 is what it was originally worth, but then what we would do is we'd get to deduct all of those amounts that have been chargeable. Now again, if you think back, for each full tax year, we were looking at the 3,000 times the 20, which was 600. And these are the questions where they give you quite a bit of history, and you'll end up thinking, why do I care what happened to this? And it was with a different person. Well, obviously, hopefully you can see here why it makes sense, because if we had to then look at a transfer of that same plasma TV, we'd be looking at that original 3,000, and then if Simon's had it for 3 years and then passed it on to Bob, we're going to be reducing that down by £600 for each of those tax years. And then hopefully that will bring us out reasonably similar values, and again, we will always take the higher of the two. So we're doing our comparison, but the comparison will be actually a bit fairer when we are allowed to deduct these amounts that have already been charged to tax. Okay, but again, if in doubt, it's the higher of the two values. Okay, so hopefully you will now look out for that twist there. And one final thing just to mention, if you're actually sold this asset, so you're not necessarily given it, it's a transfer but you have to pay something towards it, then that is again just going to count as an employee contribution. In terms of time apportioning, not actually applicable here, so we won't do any time apportioning because we're going to get the asset and it's going to be chargeable, but anything we pay towards it will be just a normal employee contribution towards that asset. Now that brings us down to the final benefit. So the final benefit is the living accommodation benefit. So let's have a look at that one and the different twists that we can see. Now the first thing to mention is obviously not everyone has a chargeable benefit here. So it's not going to be applicable for job-related people. And remember, these are the people which need to live in a property for, let's say, security purposes. It's necessary for them to perform their duties, or it's customary, so maybe a vicar or a policeman in a police house. So if we did have a question where we had one of those individuals, then there is no living accommodation benefit. Now that would, of course, make the question a bit too easy. So let's assume that that's not the case, and therefore we have something to calculate. Now in terms of the living accommodation benefit, there are effectively two sides of this. We have what we call the basic charge, and we have the additional charge. Now the basic charge is when we're basically going to compare rent paid by the employer for the property and the annual rental value. So in the question, they should give you the annual value. You're looking at basically what it would rent for if it was on the open market. And again, we're going to take the higher of these two. Now, if the employer has bought the property, then the rent paid is not going to be applicable. So if the employer's bought the property, you're just going to be basing this on the annual value. So again, a bit like use of assets, although there's two things there, the chances are you only have one to consider in the exam. Now this is one of the twists for living accommodation benefit that a lot of people get wrong. Yes, we need to consider an additional charge, but only in certain circumstances. Now the additional charge is when we have expensive properties. And of course, expensive properties, it hasn't changed for many years. We're looking at properties that have cost more than £75,000. However, the point that some students don't recognise is this is only applicable if the employer has bought the property. So if they are renting an expensive property on your behalf, you don't have an additional charge, you purely have the basic charge. So a lot of the time there will be marks available for the fact you haven't gone on and calculated the additional charge. But as you can see, probably it's more likely that you need to, because then there's more marks available. Okay, but it's not necessarily going to be the case even if you see big numbers there. Now, if we do have this additional charge, we are going to take the excess above that 75,000 and we're going to times that by, again, our official rate of interest, so that's 4%. And that will give us our taxable benefit figure, which can then go with our basic charge figure. We can total them up for a total living accommodation benefit. And again, we always need to consider whether or not we need to time apportion. So it may be that there's a period there where we haven't used it, so we can deduct, and you can show it either way. You can either deduct the period where it was unused, or what you can do instead is just times it by the relevant period. And then, like with all benefits, apart from fuel, we can deduct employee contributions. Now, what I have done there is I have put cost with little marks above it, because that's not necessarily going to be the cost. Now, if we see a large value there, that is going to warn us that we need to consider a calculation as long as the employer's bought the property. But what we need to make sure we do is consider what we call the 6-year rule. Now, if we just draw out the 6-year rule, it's not a very straight line, I do apologise. So, if the employer buys the property, so my employer bought the property back here, and then depending on when you move into the property, depends on what value you're actually going to use. Now, this isn't to do with the very first person. That was purely the use of asset rule that we saw earlier. So we are going to be looking at specifically when this employee moves into the property. So if I move into the property within 6 years from when it was purchased, then we are going to use the cost. So what we have here in our little formula will be the cost. However, if I move in after 6 years has passed, so they've bought the property, the employee then moves in this period, we're not going to be using that original cost, we're going to be using the market value instead. And a lot of questions will give you both the cost and the market value for you to work out which one is applicable. Now, whilst I have my 6-year little timeline on here, let's just very briefly talk about improvements. Now, improvements are supposed to be added if required to make the actual value of the property seem realistic. So let's say, for example, that I have made an improvement here. Okay. So just before the 6 years, so I've moved in, let's say, 2 years after the employer bought it, and then there's been lots of improvements that have been carried out on the property, and assuming those improvements are proper improvements, they've added value, what we would also need to do is, as well as taking this original cost, we would also have to increase the cost by the improvement value, because otherwise the property value that we're using isn't as realistic as it could be. Now, if, for example, I've moved in 8 years after it was originally bought, then I'm going to be basing my additional charge calculation on the market value from when I moved in. And if that's the case, that improvement that I've just mentioned has already been taken into consideration. So all you've got to think about is the value that you're about to use, does it represent that improvement or not? So if we're using the cost, the chances are we're always going to add in those improvements. Whereas if we're using the market value, the improvements that have happened before, well, they're already going to be represented in that market value that we're using. One further little twist that I would just mention, let's say that I'm going to move into a property at the end of February in a tax year. The property's not great. My firm carry out loads of improvements. They add a huge amount of value, but I've only actually benefited from it for about a month. It seems very unfair to actually add this on and increase my benefit. So the general rule with improvements is if the improvements takes place during the tax year, so the tax year that you're considering, you don't apportion it, you have to have full use of it for the year. So that means if the improvement takes place in the current tax year that you're considering, you don't add it on. But then, of course, the following year, you will have full use of it for a year, so you would then add it on in the following year. Okay, so be careful with the improvements. Generally, they're a yes. As long as the value that you were using doesn't take it into consideration, we add it on. And any improvements that take place in the tax year that we're considering, those will not be added on because we haven't had the full use for the full tax year. So, lots to take in there. We just go back to job-related accommodation. So job-related accommodation, we don't do any of this. Then if it's not job-related, we've got our two charges. The basic charge will always be there. The additional charge is only applicable if we've got an expensive property and the employer has bought that property. We would then always have to consider our 6-year rule in terms of when does that person move in as to which value we will use within our additional charge. Now, a couple of things just to add in. As well as actually providing you with living accommodation, your employer may also pay your gas, your electric, your water bills. Now, if that's the case, that's just going to be additional taxable earnings. Just like if I walked into the office tomorrow complaining about my electric bill, if they said they would pay it for me, I'm just going to be taxed as if I've received additional salary. Now, one thing just to bear in mind, because obviously with job-related accommodation, you could end up in a huge house and it may cost a fortune in order to heat it, to light it, etc. So if you're in job-related accommodation, they do actually restrict the amount that you can be charged on in terms of those utility bills. So we have a 10% of the earnings restriction. So if we have the vicar in the vicarage and he earns, let's say, £15,000 a year and his utilities are coming to £3,000, he can't be taxed on that £3,000. He can only be taxed on £1,500 maximum. Okay, so his salary, etc., his earnings are £15,000. He can only be taxed on £1,500 maximum. Now, the other good news for job-related accommodation is if you also have your council tax and your water bills paid on your behalf, then those do not come into that. Those are just an exempt benefit. So if I'm a caretaker, if I'm a vicar, if I'm a policeman in a police house, and my employer pays my council tax and my water bills, that is a tax-exempt benefit. Now, those two there should hopefully be ringing bells because we do see council tax and water in the same line when we also consider rental income and calculating our wear and tear allowance. So that's something else just to consider. So if they wanted to take it a step further, they give you job-related accommodation, and fair enough, there's nothing to calculate in terms of the normal benefit, but if the bills are paid on their behalf, we've got that 10% rule, and then we've also got to consider the exempt rule for council tax and water. Now, just to finish off, let's just have a look at one more example just to put those rules into place. So here is one I prepared earlier. So let's say we have Tolley owns a flat used by Claire. The flat cost £100,000 in 2003 when purchased. Claire moved into the flat on the 6th of October 2012 when it was worth £375,000. What is the taxable benefit? So we're told the annual value is £6,000 and Claire pays a contribution of £100 per month. Now, I thought this was quite a good question because it makes you consider the 6-year rule. Also the fact that Claire has moved in partway through the tax year, so the 6th of October 12. And if we're calculating this, let's say, for 2012-13, Then we've obviously got to do a bit of time apportioning. And then we've got an employee contribution as well. Now, if Tolley own that flat, they're not renting it. So let's start with our basic charge. So the basic charge, we've got nothing to compare. It's just going to be the annual value, which we're told is £6,000. Now, we know the flat is expensive, so we're going to have an additional charge to calculate as well. So we're going to take, and this is where we need to consider our 6-year rule. So if we just go back, they purchased it in 2003. She moves in 2012. Hopefully you can see there it's not within the 6 years from when they bought the property. So we're going to be using the market value. Now, I could have been worse. I could have put some improvements in, but let's just focus on the fundamentals. So we're using the 375,000. We're deducting our 75,000. And then, of course, we're timesing by our official rate of interest, which is 4%. Now, that gives me an additional charge of $1,200. Okay, just double check that, check my math is right. Yes, oh, 12. I was going to say that didn't look right, 12,000, apologies. So annual value of 6,000, additional charge of 12,000, and then of course if we total that up, that's £18,000, but only has use of the property for 6 months of the year, so we can either strip out the 6 months or we can times by the 6 months that they're able to use it for, so that would give us a £9,000 benefit. And we're not finished yet because we've done our time apportioning. The final thing we need to consider is, of course, the employee contributions. So we were told that she's paying £100 per month. Well, again, only 6 months worth. So let's strip out the £600, which gives us a taxable benefit of $8,400. Okay, so hopefully you can see where the numbers have come from. Annual value of 6,000, additional charge of 12,000, totals it up as 18. And because we haven't had full use of the property, we do time apportion both the annual value and the additional charge. And then, of course, when we come to doing our employee contributions, we also have to take that into consideration there as well. Okay, so that concludes the session on these benefits, the benefits with twists. So hopefully you're going to look out for these twists now with the loan benefit, the use of assets, transferring the asset. Remember, it's all about who used it first, what was it worth when it was very first used, and then, of course, our accommodation benefits with that 6-year rules. I hope this helps with your studies, and good luck for the exams.